Let's connect with Sanjiv Bhasin as well, who joins in on the show. Hi there, Sanjiv. So much to talk about, but why don't we take it then to that lagger that we were just discussing within the FMCG space, HUL, and precious little in terms of long-term returns. Latest news brokerage notes suggest that the demand trends remain very similar to Q2 and volume growth as well will be similar. What's your view on HUL and for investors who have been sitting tight but not really reaped any gains?
Yeah, good morning, Avan. I think that's the story of the large caps and particularly the heavyweights. Neither Reliance nor Lever nor Infosys have been very stellar outperformers in the last maybe 18 months. More to do with the outperformance of the mid and small cap. Now, Lever is not a cheap stock by any standard, and it is a very big play on the sheer weight of its size. So yes, there is this quarterly weakness which seeps in. And we know that competition is biting. We have stayed away from Lever. In fact, we are overweight on Godrej Consumer, Nestle, and in that same space of QSR, Devyani International. We think those are better plays. Lever will be a market performer. It is not going to outperform, but because of its large presence and the ability to change portfolios, it remains a very good add in your portfolio over a period of time. However, like we said, we find the growth rate of Nestle, Godrej Consumer, and Devyani to be far superior in the short to medium term, and we would start to focus. We want to focus on those three stocks, and these three stocks are in our portfolio as a disclosure.
Right. Sanjiv, hi, morning. Wanted to discuss Paytm and these, takeaways from their conference call, wherein there is a rethink clearly on the loan distribution and the kind of ticket sizes that they're going to target. And they've categorically said that they're going to be focusing on expanding high-ticket personal loans and merchant loans and will continue to add banks and NBFCs as their lending partners. Brokerages this morning are not liking it, especially that, Paytm is no more a cheap stock.
Yeah, good morning, Aisha. Correct. But that is the whole scenario which has changed from the RBI governor's caution on unsecured lending and personal loans. And we know that in the Kirana space, the below 50,000 ticket, Paytm had a huge market share for its own business. But I think it's a transition. It is a matter of a couple of quarters. See, this is not a stock which is to be measured on a quarter to quarter. There will be transitions for such a big play, but you cannot do without Paytm. In today's India of 140 crore, Paytm is a necessity in everyone's, daily usage. So their ability to transition may take a few quarters. We would definitely like to add this stock. This is in our portfolio. It's one of our top fintech along with PB Fintech and Zomato. But we think that this transition may be over a period of time as the RBI recalibrates. But look at the global scenario. Bond yields are hitting maybe a 6-month low. Oil is headed to a 1-year low. And rates are definitely going to be cut in the US, which means the caution from the RBI may be short-lived for the short term. But over a period of time, I think it will be back to normal. And they are recalibrating their portfolio. So yes, this transition may be a little bit of a dampener on the stock, but it will be definitely an add-on declines to add to your portfolio over the next 2-3 years.
Right. Sanjiv, just to go back to the first point that you were talking about, that very slow or practically no movement in some of the large cap stocks. So what is it that you're advising one do at this juncture with, the ICICI banks, Reliance Industries, ITCs, etc. Of the world? Do you believe that it's time to book a little bit of, your book out of some of these counters? What exactly would be the approach to some of these marquee large cap names?
So, Aman, if you recall, we've been suggesting the Bank Nifty as an index, and that was closer to that 44,500, 45,000. The Bank Nifty has definitely outperformed, and we still think banks are going to lead the way forward. Lower yields, lower inflation, all bode well. I think the RBI will be on status quo today and tomorrow. And I think banks are the heavyweights which will actually add more color to the momentum. You can see a Reliance definitely outperform on the back that GRMs will be smart. Their retail play, ARPUs are doing extremely well, sum of parts. So a couple of these plays will be good. Index looks set that it has run up quite a bit. You could take a bit of profit or chips, but the real money is in the broader market, and that is what the market is trying to tell you. However, we think now some of the banks, particularly the large caps like ICICI, HDFC, Kotak, they are giving you a very good entry opportunity. You can couple that and add a Reliance, and you will have a good portfolio. The others, like you pointed out, could be either on the sideline or avoided for the time being.
Now, speaking of EVs, let's get in your take then, Sanjiv, as to what the outlook is within the entire auto space. Tata Motors, for instance, yesterday was on the gainer side. You had an M&M as well, which has fired up. What's the view looking at the long term of some of these auto companies?
So, Awan, none of them are cheap. They're all hitting new fresh highs, and that is telling you that now the gamut of FI money will chase the ones which are outperformers, and the portfolio stocks from auto have been missing from a large part of the foreigners. I still think there is room on the upside. Our preferred picks remain Maruti on the four-wheeler, Ashok Leyland on the CV side, and we like Hiromoto on the two-wheeler side. Remember, Ola Electric is seeing weakness at the cost of Ather Energy, which is 100% owned by Hiromoto. And Hiromoto has made far-reaching changes in their portfolio, and now their sales outlook on the back of rural income is looking very, very strong. So these three stocks are in our portfolio as a disclosure. We think these are going to be the outperformers. The rest will be market performers because there is a lot of profit booking and advice which is coming, since a lot of them have actually overshot their price targets.
Right. Sanjiv, also want to understand, given your contra thoughts right now and power, and we spoke about this yesterday as well, just probing it a little bit because, there's still so much FOMO feeling out there. I know you mentioned yesterday that Tata Power continues to be a top bet within power. It's not like a blanket profit taking that you're putting out for the power sector. But the FOMO feeling will definitely chase some of these power names, indicating further headroom in some of these stocks.
So, Aisha, that is always a glass half full, half empty. And my call was that on your trading side, on your derivatives position, REC, PFC, NTPC look fully stressed. I continue to reiterate Tata Power is the best stock to buy along with IEX. These are both in our portfolios. Tata Power from the 200 levels has reached just 300. It is, the management is sounding very optimistic of doubling profits. IEX is the best trading platform which you have, and volumes will grow 10, 15 times in the next 5 years. But in the others, there is no room of comfort. Like you said, they are hitting new highs, no running away from the fact. But we have been an advocate and bought these stocks at much lower levels. We have tried to hedge ourselves, but we think now the room of safety over here, Aisha, is very, very little. Hence, we advocate other positions in other stocks rather than chase power at new highs. Because like I said, it's a glass half full, half empty. The feeling of missed out is going to drive euphoria, which will actually end in a bad way.